Welcome to Talk Tickers, the earnings call summary that gets straight to the signal.
Today, we're diving into a really monumental report, one that clearly resonated with the street. This is the Q4 2025 earnings call for Tetra Tech, ticker TTEK.
The setup here was, well, electric. TTEK dropped their Q4 results, and judging by the market reaction, the core thesis is not only intact, but accelerating.
Absolutely.
We're going to break down the record numbers, that 30-year high margin, the big pivot to water infrastructure, and why the company feels confident enough to raise guidance, even with some headwinds.
Okay, so let's start with the headline numbers. These are really what drove that extraordinary move in the share price.
What did they deliver on the bottom line?
So adjusted EPS, and this is key. This is excluding the lower margin USAI and Department of State work. It came in at 44 cents.
Which was a big beat, right?
A huge beat, a substantial 10% beat against the street's consensus of 40 cents. It just, reflects some really impressive execution.
And the top line backed that up.
Oh, absolutely. Net revenue, using that same core metric, hit $1.07 billion. That's 10% year-over-year growth and a massive beat against what people were expecting.
Okay, but here's where the story gets really interesting for me. The margins. Adjusted operating income jumped 23%.
To $171 million.
And management specifically said, they highlighted it, operating margin hit its highest level in more than 30 years. That's not just a good quarter. That's a fundamental shift.
It's a transformation. And you see it in the cash flow, too. Fiscal year operating cash flow was $458 million, up 28%.
And it's still exceeding net income, which is always a great sign.
Always. It speaks to really high efficiency and, frankly, clean accounting.
Okay, so let's unpack that margin story. A multi-decade high doesn't just happen. What exactly drove that kind of performance?
It's a very deliberate, two-pronged approach. First, you have the strategic move to get out of lower margin work.
The USA DDoS?
Exactly. Getting rid of that work created an immediate structural lift to their margins. It's what drove their government services group, the GSG segment, to a record 22.9% margin.
So they basically made a choice to trade some revenue volume for a massive upgrade in quality.
That's a perfect way to put it. And then the second part is the tactical execution. They're shifting the contract mix to more fixed price work.
I saw that, 50% this quarter.
50%, the highest in decades. And what that does, it allows them to capture more of the upside from their own efficiency and their digital tools. They're so confident in it, they're now targeting 60% fixed price.
So they're literally profiting from their own engineering excellence.
Precisely.
Looking at the segments, GSG revenue spiked 17% year over year. Commercial and international, CIG, that was up 7%.
Yeah.
What was lighting the fire there?
It's all highly thematic, tied to these huge long-term infrastructure needs. For GSG, some of the momentum came from fire disaster response work.
Which is high margin but temporary.
Right, a bit of a temporary factor. But the more sustainable drivers were strong execution in water infrastructure and digital water automation for state and local clients.
And on the international side, that's almost half their business now.
Yeah, international now makes up 45% of the business. The growth there was really fueled by their UK water business and big investments in clean energy up in Canada.
And they also mentioned some big defense contracts.
Over $1.2 billion in new contracts from U.S. defense agencies. Major awards from the Army Corps of Engineers, USC, in places like Baltimore, Mobile, Norfolk.
And what kind of work is that? Is it building things or something else?
It's more about resilience and environmental work. A lot of it is tied to the U.S. Navy, things like flood protection for coastal bases, and crucially addressing PFAS contamination.
The forever chemicals. Yeah. That seems like a massive long-term tailwind.
It is. The Department of Defense is facing a huge mandate to clean up these sites. TTEK's high-end science focus just puts them in the perfect position for that kind of long-duration, high-margin work.
So the call made it very clear that they're positioning the company around these huge, resilient macro trends. And two areas really jumped out: data centers and high voltage transmission.
Absolutely. The core message is water management. They call it their enduring competitive advantage, and it ties directly into the AI build-out.
Because a data center needs a staggering amount of water.
It's incredible. A large data center can consume 5 million gallons of water a day.
Wow.
So TTEK is providing resource management, high voltage engineering for the power, and water reuse services to more than a dozen of these hyperscale operators.
And you can see that in the numbers. They said their high-voltage engineering backlog doubled in the quarter, up 120% in the U.S.
Exactly. That's a direct proof. The AI build-out is creating direct demand for their most specialized high-margin services.
Okay, this all sounds incredibly strong. Structural improvements, huge macro trends. So let's talk about the one thing that seemed to confuse analysts on the call.
The backlog.
The backlog. If things are so strong, why did the headline backlog come in flat at $4.14 billion?
Yeah, that's a fair question, and management had to explain it carefully. They talked about a decoupling of backlog from revenue growth, mainly because of how U.S. federal contracts are changing.
What's changing?
The government is issuing shorter task orders. It's something the industry calls book and burn. The work gets contracted and executed so fast, sometimes in the same quarter, that it doesn't even sit in the reported backlog number for long.
So their visibility is actually lower then.
Well, that's the tension.
Yeah.
Management argues that the total contract capacity, so the maximum value they could get, is actually up 15%. They say it's just a reporting change.
I see.
And thankfully, that federal issue was offset by strong backlog growth everywhere else: state, local, commercial, and international.
They did acknowledge some soft spots, though. Some real headwinds. What were they?
A few things. U.S. commercial work was a bit down, mostly in offshore wind and some renewables projects.
And the government shutdown had an impact.
It did. They estimated it cut about 15 to 20 million from Q4 revenue, and maybe the most important one. Their digital business stalled.
The high-margin SaaS part of the story, what happened there?
It stalled at about a $25 million run rate. The reason was a federal moratorium on buying new software packages. Management sees it as temporary, but it definitely delayed their plans.
So putting it all together, record quarter, margin expansion, but some acknowledged headwinds. What's the official guidance for next year?
The guidance is pretty robust. They're guiding for net revenue of 5 to 4.25 billion. So that implies about 5 to 11% growth.
And for EPS?
EPS guidance is $1.40 to $1.55. They expect the growth to ramp up through the year as some of those headwinds, like the digital freeze, start to fade.
The financial foundation seems rock solid. Low debt, high cash flow. How are they thinking about capital allocation, especially M&A?
The balance sheet is a fortress. Net debt to EBITDA is just 0.9 times. So they raised the dividend 12%. They bought back $50 million in stock.
But the real story is M&A with that kind of balance sheet.
Exactly. Management thinks the recent market volatility is creating opportunities. And crucially, TTEK has access to really cheap capital. They have a 2% interest rate from an old convertible debt deal.
Which means they can do accretive deals much more easily than their competitors.
Way more easily. And they said M&A will be a slightly larger contributor to hitting their long-term 2030 targets.
All right, time for our not financial advice segment. We take what we just learned and pitch an outrageous but plausible trade idea.
Okay.
The thesis seems clear. TTEK is morphing from a cyclical engineer into a high-margin, water-focused tech platform. The biggest driver is the insatiable demand for water from data centers.
Right. And my focus is on how they can deepen that moat. Right now, they consult on water. They're experts in managing it, but they don't own the actual asset.
The water itself. What's the pitch?
With their 0.9x leverage and that cheap debt, TTEK should do something transformative. The outrageous trade is to buy TTEK and buy long-dated call options, betting on a $1 billion acquisition of a regional water utility or a big portfolio of water rights in the U.S. Southwest or Texas.
Wow, buying a utility, that's a huge shift. Why is that plausible?
Because it would pivot them from just consulting on water efficiency to actually owning the supply that feeds the data centers and chip fabs. It locks in recurring, non-cyclical revenue.
It would completely change their valuation profile.
Completely. It vertically integrates their entire strategy. It validates their leading with science motto and pushes them into a whole new valuation multiple, one that's usually reserved for stable, utility-like infrastructure companies.
Okay, so as we wrap this up, what are the key takeaways for you?
TTEK delivered a record quarter, and the 30-year high margin is the proof that their strategic pivot is working. They're successfully moving up the value chain.
And guidance is strong, but you need to keep an eye on those temporary headwinds in renewables and federal digital services.
Exactly. The big question for me is execution against those growth targets, and maybe more excitingly, whether they use that cheap capital to do a truly transformative M&A deal that changes the entire story.
Thank you for joining us for this deep dive into Tetra Tech's latest earnings call. We'll catch you on the next Talk Tickers.